Alright, so hi guys, we are finally approaching the end of September. So what can we expect moving forward? Well, if you take a look at the stock market seasonal pattern, especially during the midterm election years, which this year is one of them, we should expect a very strong rally towards the end of the year. Now, for most years in general, there is always that year-end rally, but US midterm election years tend to be even stronger. If you take a look at the average of all past midterm election years, you can see that the market tends to be very bearish throughout most of that year. And this year has been exceptionally bearish, as you guys know, because of high inflation and the Fed doing monetary tightening. So we've been going down mostly throughout this entire year. It's been really challenging for investors and traders. But we're coming to an interesting point in time. So you can see that historically, during the mid to late September, the market tends to bottom and stage a very strong rally all the way to the end of the year. So can we expect this to play out this year? Will the market rally strongly in the last quarter to make back the losses or make back at least half of the drawdowns? More and more people don't think so. More and more people are getting really bearish and thinking that no, there's going to be no rally. We're going to keep going down. Why? Because recent price action has been really bearish. So initially, they looked like there could be some bullish hope, right? We made a low on the 16th of June, and then from there, the market rallied really strongly by about 18%. And then we know what happened. It hit this strong resistance at the 200 moving average and then pulled back very strongly because of the Fed's really tough, aggressive talk at Jackson Hole that caused that big sell down over there. And then the market hit this point. And this point was a strong trending support level, which I mentioned. At the same time, it also coincided with this really strong 3,900 level over here. And I said that, hey, if the market can kind of like, find support there and bounce back up, hey, we could rally all the way from here, right? So we're all looking at that. And it looked like it was going to happen. The market hit that level, and sure enough, we had that rally, okay? But then something happened. On the 13th of September, CPI data, inflation data came in worse than expected. It came in at 8.3% inflation rate, which is worse than the 8.1% that the market was expecting, although it was still down from the 8.5% the previous month. But the market didn't care. So the market freaked out and prices dropped to that support level. And I said, okay, let's hope that support level holds. And it looked like it was holding, right? And then the next bombshell report came out. FedEx reported worse than expected earnings and sales, but even worse was they cut their forward guidance by half. And the CEO came out and said that, you know what, it's not our fault. We're in the middle of now a global recession. It's gonna get a lot worse. And FedEx stock price dropped by 20%, and that put down the whole market. So the market dropped below that critical support level on that day, the 16th of September. And of course, bears are now saying, see, I told you so. We're going to go back down. We're going to go back down all the way, and we're going to retest that 17 June support level, which is, of course, is possible, right? But the bigger bears on Wall Street are saying, no, that's not the end. We're going to drop another 20 to 25% from here. That's the narrative that the majority of Wall Street analysts are saying. Like this guy, Minard from Guggenheim. He said that stocks should fall another 20% by mid-October, and here's why, right? So with all this bearish news, with everyone thinking the market's going to go down, there's no more rally, what should we do as investors? Should we say, okay, let's throw in the towel, let's sell everything, get out, right? Short the market and maybe buy it back lower? Maybe, but maybe not. So is there anything to be bullish about? Is there any hope that the market may bottom really soon, sooner than we expect, and stage a strong rally? Let's go and take a look back at the charts. Now, something interesting happened. So on this day, the market dropped below that key support level. It looked like it was really bearish, looked like it was going to go down. But then the market, or the S&P, closed as a bullish pin bar pattern. By the way, even though it's a red candle, it's still a bullish pin bar because we've got a small body and long lower shadow. And that's usually a reversal pattern, but by itself, it is not really meaningful, right? But then the next day, which was yesterday, the S&P closed with a bullish engulfing pattern. There could be some hope. And here's the interesting thing, right? Usually if the market expects a global recession, if the market expects we're going to go into a recession, what do you think people do? People will sell consumer discretionary stocks, cyclical stocks, and they'll plow into consumer staple stocks, which are the safety stocks, right? But that ain't happening. If you take a look at the XLY is the consumer discretionary ETF, you find that when the overall market made a lower low in the last couple of weeks or the last week or so, the consumer discretionary ETF made a higher low. So that's what we call divergence. In other words, while the whole market went down a bit, but consumer discretionary stocks actually went up. So why? That means that under the hood, something else is going on. There's some kind of bullish divergence happening. Now, I also look at the advanced decline line. This is a line that measures the number of stocks advancing, making gains, versus stocks declining, right? The advanced decline line. Now, usually when the market goes down, the advanced decline line should go down. Market goes up, the advanced decline line should go up. But here's what's happened recently as well. Last couple of weeks, the market made a lower low, breaking that support level, right? But if you look at the advanced decline line, it did not go lower than that previous low. It made a higher low. And once again, we have divergence on the advanced decline line, suggesting that this recent sell-off is not as broad-based as people think. It's not as bearish as people think. Now, of course, this is not enough. We need to see that the market in the next couple of days, can it actually close back above this 3,900 level? I don't know, right? I can't predict that. But here's the point. If the market can close back above that level, that's going to be really bullish, because it tells us that this was actually a bear trap, trapping the bears. When the market broke down, the bears got excited, the bears went to short the market. If the market can close back up, then the bears are screwed. The market would then have a chance of rallying and rip the face off the bears. Okay, will that happen? I don't know. I'm looking closely at that. Now again, you may say, hey, these are just chart patterns. They don't mean that much. Well, let's take a look at some of the fundamentals. So remember that one of the things that caused the market to sell down strongly in the last few days was the CPI data, the inflation data that was worse than expected. Now, has this happened before in history? Yes. In fact, in history, you will see that when the market reacted very badly to inflation data, it all happened during previous market bottoms or near market bottoms. So this particular instance was one of the 10 worst CPI 1 week market reactions. When were the previous 9? Well, happened here in 1974, August and September, August 1990, June 2002, February 2009, November 2011, August 2015, March 2020, and of course, very recently, now June, August, and now September 2022. And take a look. During all those previous times when CPI was released and the market dropped because of the CPI data, the market was very near market bottom. So could this be the case this time? Maybe, right? So this gives us some hope that we could be closer to the bottom than we think. And from all those previous points in time, the market returned an average of 19% in the next 6 months, with a near 90% probability, which means that there's a 90% probability the market is going to rise at least 19% from current levels. So looking back historically to the previous high inflation periods, because a lot of people are comparing this market to the 1970s, right? 1970, 1974, and 1980 during the high inflation period. And you find that in those periods, a peak in CPI inflation coincided with market bottoms. Could this be the case today? Maybe. Now, what was the other news that sent the market crashing below the support level? The FedEx warning. So FedEx came out and said we are doing badly, and it's not our fault. It's because we are now in the midst of a global recession because of Europe, because of Asia. Everything is collapsing. We're all gonna die. That's what they're saying, right? But the question is this: is this same thing? Is UPS saying the same thing? Because if UPS is saying the same thing, then I agree. We're in a global recession. We're all screwed, right? But if UPS comes out and says, you know what? What recession? We don't see no recession. That means it's not the global recession. It is FedEx problem. It's a company problem that they're not executing well. It's kind of like your kid comes back from school and shows you the grades and say, I failed my exam. You say, why do you fail the exam? Oh, because the exam was really tough, right? But then his friend, comes in and says, no, exam was easy, right? You slap your kid and say, you idiot, it was you, right? So is it FedEx's problem or is it really the global recession problem? Well, let's take a look at this over here. Now, first of all, understand that FedEx, before this whole global slowdown and the Fed raising rates, they were already not performing well. They already had a lot of company problems, whereas their main competitor UPS was actually doing pretty well. So if you take a look at the last 2 years, you can see that UPS, their main competitor, outperformed the S&P 500, up 77%. Whereas FedEx, even before this event, was underperforming the market. So the company itself has a problem. But of course, this is not enough to say that, it's not the global economy that's causing this as well. Here's something interesting over here. UPS, back in late July, they actually affirmed their full year financial targets. So what UPS said was that, we are projecting, a great quarter ahead, great year ahead, and we reaffirm this forecast. Now, just last week, they were asked again, are you still reaffirming this forecast? Do you still think you're going to do well? And they, yep, there's no change in the forecast. So that tells you that, hey, wait a minute. If things have deteriorated the last 3 months, why isn't it affecting UPS? Shouldn't it affect UPS as well? Right? So this is another clue that maybe it is FedEx having a problem and they're blaming the economy. Right? Or could it be that FedEx is just losing market share to UPS and losing market share to Amazon? Now, if you guys have been following me, especially my students, you remember me last year. Now, I used to own FedEx stock, but I sold it about 1.5 years ago because I said at that time, I think FedEx is going to be in trouble because their biggest competitor is not UPS, it is Amazon. In fact, Amazon used to be FedEx's biggest customer, and now FedEx has started their own logistics business to compete with FedEx. And at that point, I said there's no way they're going to compete, right? So remember, I've said this many times. Amazon is one of my favorite companies right now because Amazon, if you invest in Amazon, you're buying 5 companies into one, right? A lot of people think that Amazon's e-commerce. No, that's only one business. They're the leader in e-commerce. They're also the leader in cloud computing. They are also now gaining market share in their Amazon Prime, their videos, right? With the new Lord of the Rings series, things like that. But that's still a big question mark. They are also a leader, one of the leaders in advertising. Amazon's advertising business has overtaken YouTube. That's how big they are, but people don't think about that. The 5th business that Amazon is in is logistics. That's right. Amazon has invested billions in the last 2 years to build this monstrous fulfillment business in logistics where they are competing head-on with FedEx and UPS right now. Now, if you take a look at market share of package carriers, you can see what's happening. FedEx has been losing market share all the way since 2012. For the last 10 years, they've been losing market share. Okay? Now, UPS also going down, but not as much, right? But guess who's eating everyone's lunch? Amazon, right? Amazon is now becoming one of the leaders in freight and logistics. So that's something to think about. So this whole talk about, global recession, we're all gonna die. Yes, I agree the global economy is slowing down. Definitely Asia's slowing down. Europe is probably in a recession right now. The US is slowing down, but global recession, maybe, but maybe not. All right, maybe it's not as bad as what FedEx is saying. That's what I'm saying. Okay, now, so there is a possibility. There is a possibility that we could bottom before most people expect, and we could still have that very strong year-end rally. I'm not surprised if that happens. But a lot of people keep telling me this. They say, Adam, what? Don't fight the Fed. Don't fight the Fed. If the Fed is raising interest rates, there's no way the stock market can go up. People have this idea that if the Fed raises interest rates, the stock market can't go up. Who the hell said so? Now, if you study history, you know that there are many times when the Fed raised interest rates and the stock market went up. Take a look since 1990, right? Now, you can see this yellow line is the Fed funds rate, right? The Fed's short-term interest rates, which they control. And over here is the S&P 500. Now, take a look at this, right? Over here, the Fed raised interest rates from about 3% to 6% interest rate. Can you see over there? What happened to the stock market when the Fed raised interest rates? The market went up. The Fed raised interest rates over here from 5% to 6.5%, the stock market went up. The Fed raised interest rates over here from 1% to 5%, the stock market went up. The Fed raised interest rates from 0% to about 3%, stock market went up. So don't give me this bullshit that, oh, the market can't go up if interest rates are rising. No, it's not true, all right? This time, you can see that, yes, the Fed raising interest rates, market coming down. But the reason the market's coming down is not just because of Fed raising interest rates, but it's more because of this hyperinflation. So the key is the inflation data that we have to look at. Now, if you take a look at this, I've shown this before that if you look at past high inflationary periods, which is the 1970s and 1980s, what had to happen for the market to bottom? No, it was not the Fed stopping interest rate increases. It's not the Fed that much, right? It's actually inflation peaking. When inflation peaks and comes down, that's when the market bottoms. Take a look at this. This over here is the inflation rate, and this is the S&P 500. So again, take a look. Inflation peaks and falls, and the market bottoms and rallies. Inflation peaks and falls, market bottoms and rallies. Oh, sorry, this one over here. Inflation peaks and falls, market bottoms and rallies. So it's about inflation peaking. So right now we are over here, all right? And so question is, has inflation peaked? If inflation indeed has peaked and is coming down, market could be closer to a bottom than people think. Now, if you take a look at the last CPI report, you say, but inflation is not coming down as what people expect. It could be more sticky, could go up. Yeah, sure, possible, right? But understand that CPI report is lagging, right? Whatever they report, it's lagging. It's a lagging indicator. So we want to look at leading indicators. Are the leading indicators of inflation going up or going down? And the answer is they're all going down. All the drivers of inflation are going down. Oil prices are going down. Commodity prices are going down. Housing prices are going down. Rents are going down, right? So everything that's driving inflation is going down. But all this is in the leading indicators. And you only come in to the CPI report in the next 1 or 2 months. But once it happens, then we could see a bottom in the stock market. So one of the things that I'm looking at is the 10-year treasury yield, all right? Because in a way, it's kind of like a proxy for inflation expectations. So when the market expects higher inflation, the 10-year yield will rise, right? Market expects low inflation, the 10-year yield will fall. So one of the things we're looking at, and you can see, sure enough, for the whole of this year, the 10-year yield over here, as it rose, whoa, the market came down. And what happened over here in late May? In late May, the 10-year yield peaked at 3.5%. Can you see that? And the market bottomed at that point. And you can see the yield came down, the market went up. So right now, the market is moving opposite of the 10-year yield. So right now, as the 10-year yield is going up again, the market's going down. Can you see that negative correlation, right? Now, what is interesting is you can see that the 10-year yield is now approaching this peak over here in middle of May, right? So will it break through that peak? I don't know. I can't predict, right? Or could it hit that peak and come back down and make that double top, right? I'm watching that. So if this can kind of like make a double top, and sometimes it may go a bit over that first top and then reverse back down. So if this can kind of like top out and come back down, then this would signal a very, very strong bottom in the markets, and we could see a very strong rally towards the end of the year. So I'm watching the 10-year yield as well. So as investors, what should we do? Because there's such conflicting opinions out there. Again, there are many analysts who say that the stock market could drop another 20 to 30%, like this guy Menard from Guggenheim, right? But then if you analyze the data, you find that there's also evidence that the market could be near a bottom and it could rally from here. So as an investor, what do you do? Now, people always think that if I stay in the market, there's a risk that it can go lower. True, there is a risk it can go lower another 20%. But at the same time, remember that if you sell out now, if you get out of the market, there's also a bigger risk. And the bigger risk is that if the market goes up 10, 20, 30% from here, you miss out all that upside. And to me, the risk of staying out of the market is greater than the risk of staying in the market. Why? Because if you stay in the market and the market goes down, it only goes down in the short term. It will always go up eventually if you're invested in the index or in fundamentally good companies. So in other words, you always win at the end of the day if you stay in the market, right? But if you stay out of the market and the market really bottoms and goes up 10, 20, 30% and goes up another 200%, then you never ever get to grow your wealth. You never ever get to grow your account. In fact, you could end up losing money because you sell below your average cost. So that's something to think about. Now, by the way, here's another article where Menard says he sees the chance of the S&P falling as low as 1,200 points. Now, take a closer look at the date of this article. The date was 18 April 2020, when this exact guy said the market's going to go down to 1,002. Now, what happened on 18 April 2020? April 2020, the S&P 500 went from 2,800 points all the way to about 3,900 points by the end of that year, 2020, and went up to 4,600 points by the end of 2021. So that's the danger of getting scared out of the markets, selling out, locking in your losses, and then missing out on huge gains that follow. Remember, in the short term, no one can predict where the market's going. Market could go up from here, market could bottom, could go lower, no one knows. But again, in the long run, it always goes up. So time in the markets is more important than trying to time the markets all the time. This has been Adam Khoo, and I'll see you in the next video. May the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.